It's only entertainment.
All right, welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. My guest with me today, Andrew Thut. He's the CFO of Forefront Ventures. Ticker symbol available in the U.S. under OTC, ticker symbol FFNTF. Andrew, thanks for being back on the Talking Hedge.
Thanks for having me. Good to see you, Josh.
Good to see you. Thanks for being back. Let's jump right off into some stuff that I want to talk about, namely differentiation. Because Forefront, you guys are a vertically integrated multi-state cannabis operator in strategic medical and adult use cannabis markets. That includes California and Illinois, Massachusetts, Michigan, Washington. But that just kind of sounds like an MSO to the average person. So what actually sets Forefront Ventures apart from other MSOs in the cannabis industry?
Well, I mean, we sort of started out, the truncated story of Forefront is we started out in the really competitive market of Washington State. So, our facilities in Washington, are the number 2 flower producer, number 1 edibles producer. And when you look at those facilities, they look more like CPG than, you would see in a lot of places in cannabis, consumer packaged goods. Highly automated, highly efficient, wringing the labor out wherever you can. And the point of me telling you this is that, very early on, we saw our experience in Washington where we're still able to generate a significant amount of cash flow, despite that being a really competitive industry where flower prices have eroded down to the, as low as $500-600 a pound. And so going back 5 years, we sort of looked at that and said, well, pricing degradation is going to be a fact of life in the cannabis industry. And for us to have success, you have to be a low-cost producer, because prices per pound are not going to be $3,000-4,000 per pound for flower. You have to be able to wring out the costs. You have to be able to put out a really quality product at a great price. And if you do that, the elasticity in cannabis is such that you should be able to take a lot of market share. And so our differentiation has really been around, being a low-cost producer, having, new suites of products that come available, and are continuing to innovate.
Mm-hmm. Yeah, well, I'm in Washington. I'm in Seattle. It's definitely a petri dish experiment out here. And if you can survive in this market, then I think what you're learning and what you're able to do, you can bring to other markets and thrive. And so,
well, that, and that's really, what we're trying to do here. It's take what you've done in Washington State and take it to Massachusetts, which we've already done. And currently, I think that we're about 3.5-4% market share in Massachusetts. And continuing to trend up, despite some really severe pricing headwinds in Mass. And our next stop is taking it to Illinois, where we are going to be opening our 48,000 square feet of canopy, 70,000 square foot processing facility in Madison. So the first stop was taking what we did in Washington to Mass, Illinois, and we're also doing it in California.
Okay. Curious if you're looking at any acquisitions or just expanding where you're already at. I've been hearing a lot from investors that may have been on the sidelines. Now they're kind of looking to pursue that distressed asset package that's coming up. So cannabis capital raises are still off to like a multi-year low, not raising nearly enough. So for instance, only 77 million was raised through the first 5 weeks of the year compared to 662 million raised last year. So you guys actively evaluating investment opportunities, and does that include distressed assets in legacy markets like Washington?
Yeah, so it is, sort of two pieces there. Are there distressed pieces that we're interested in, and what the access to capital looks like right now? And the piece about, the access to capital is as tight in cannabis. This is my 9th year right now in cannabis. This is as tight as I've ever seen the environment. And to even have a chance of raising any capital, you have to either be cash flow positive or you have to have a view towards being cash flow positive pretty quickly. So that's the first thing. And so that's been a big focus of ours, making sure that, we have a very clear path to being cash flow positive, which is a Q1 event for us. The second piece is a little tricky. Are there distressed assets? Yes, there are distressed assets all over the industry. And the question is not really around, are there some interesting pieces you'd want to take on? The question for us is more around, do we have the people? Do we have the talent internally to take on another state, to take on another asset? In California, we entered California last July, just about this, or last January, excuse me. And, we went in with 170,000 square foot processing facility, where we're providing low cost goods into the California market. And as we started to produce, he said, well, maybe it'd be interesting to add some retail here. And the problem with distressed assets is, yes, it's distressed. Yes, it's cheap, but they're going to have $15 million of payables on the balance sheet. They're going to have a tax liability on the balance sheet. They're going to have a senior lender that thinks he should be made whole. So I think that the distressed assets in this industry really need to be carried for a couple more rounds, and have all those liabilities go away in some sort of insolvency before there are really bargains. And I think we'll probably see that as the year continues to unfold.
That's an interesting observation.
Like it's bad out there right now.
It is, and I don't know if anybody's immune to it. I want to highlight some of the bad and get your take on it. Let's go with average valuation multiples for the largest MSOs, more than twice that of their tier 3 competitors, implying an enormous cost of capital advantage that makes it nearly impossible for some of the smaller companies to maintain that growth. And yet MedMen is a dumpster fire. Cureleaf had to leave California, Oregon, Colorado. Air Wellness had to leave Arizona. They've got some other issues. So with MSO life, seemingly the life expectancy declining, I got to ask, Andrew, will the remaining MSOs be able to survive the federal legalization without that safety net of limited license states?
I think a lot of them are going to fail. I think that there's a chance that 60% of this industry fails. And the reason I say that is because there just isn't the operating expertise that underpins, the operations just don't. The operations at a lot of these companies just aren't good enough to withstand operating with very little liquidity, operating on very thin margins, and seeing some of that price compression in the flower. So I think that the multiples. So the way that I think that there's going to be the have and the have-nots. So I think that there's probably going to be 10 publicly traded companies right now that are going to make it through to the other side. I think there's probably the next 10 in some way, shape, or form, maybe part of something bigger. I think that you have to be cash flow positive. You have to be at least cash flow break even to even have a chance of surviving. But here's the good news. So we all know what the bad news is. The bad news is, the federal government didn't give us any movement on anything cannabis related, with both chambers of the House blue and the presidency blue. That pricing's coming down in some of these East Coast states, these limited license states. Everyone kind of knows that. And, you've seen just a brutal 24 months in the stocks. Mm-hmm. I think that we're going to get into a point where the really weak players are going to continue to fall off or be consolidated, probably just go away. And then I think that the 10 remaining, I think that we will get safe banking here before Joe Biden leaves office. I'm hearing there could actually be bills filed as soon as March. Everyone's credibility is so shot on safe banking coming through that no one even wants to talk about it. But if we were to get safe banking, if we were to get some movement on the federal side, like you look at an ETF like MSOS, that thing got, I don't know, when the Georgia special election happened, I think it got close to $1 billion of inflows inside of 6 weeks. And so if you think about from a capital markets standpoint, what that could mean, it's like, well, shit, all of a sudden you're going to have, a really down and out industry where sentiment couldn't be worse. And you start to see, well, wow, these guys are actually generating cash. And by the way, we're getting movement on the federal side. And, you have a potential for billions of dollars of capital to basically chase 10 to 15 names. So, we are, I sort of say, well, it's bad out there. Well, it is bad. Like, there's not a lot of access to capital. It's a competitive business, and it's, overtaxed right now. But if you want to look out 18 to 24 months, I think that you're looking at a shelled out industry where you can kind of pick, the good operators and make some bets. And I think that there's opportunity to make a lot of money.
Mm-hmm.
You have to be careful of making sure that, folks are cash flow positive so that they weather the storm.
Yeah, which kind of creates opportunities or issues for those that don't have that cash, right? So when we look at what we've seen last year with the 10 U.S. multi-state operators owing $500 million to the IRS, Forefront had past due taxes above its Q3 ending cash position. And at one point, Forefront owed the IRS $32 million, but only had $5 million in cash and equivalents. So if Forefront paid its entire past due incoming tax bill in September 30th of 2022, it would have had some serious issues, including overdrafts of $27 million. So presuming you're just paying 6% to the IRS, which is a great loan, how do you balance taking on debt with maximizing first mover advantages?
It's a great question. One of the things that, the industry is looking to fund is, whether, 280E is even if it's even legal, if the federal government can, levy those kind of taxes. And so, my partner, Carl Toscano, president of Forefront, is actually a recovering tax attorney. So, we've been, spending a lot of time, looking at, addressing the cash issue, and sort of going into discussions with the IRS on, how that's going to be repayment. But your point is right on. It's a cheap cost. It's a cheap cost of capital. So, from our standpoint, we're going to be, as we flip the cash flow positive this quarter, we're going to start to be, chipping into paying down some of the taxes. And I think that, we'll also see, us, probably expand our senior debt a little bit. But, right now, to be honest with you, Josh, this industry is in, it's like the March Madness. It's survive and advance. Mm-hmm. And right now it's a lot like it was in 2019, where it's, okay, we're going to get through to the other side of this, and through this very tumultuous time in the cannabis industry. And, you need to make sure that you have enough cash to withstand it, and you have to be cash flow positive. So in terms of us on cash, we finished the year with about 13 million in cash on the balance sheet. And, flipping to cash flow positive in March, we're feeling decent about it. We still have some work to do on our balance sheet to make sure that we have the flexibility to do everything that we want to do. We have 2 retail locations in Illinois right now. We want 8. So, we are, currently in discussions with, a lot of different types of investors about how we can deploy money on very high ROI projects with very, how should I say it? Not super risky uses of capital, higher and have an incredibly high RR, and sort of building out our retail footprint in Illinois. And so there is capital available for specific projects like that.
Mm-hmm. A lot of capital normally would come from the public markets. Being publicly traded, though, doesn't always help in an industry that just moves with the news. And not even independent. It hasn't moved independent of stocks. We've said that before. It's not really about fundamentals, but it's not even about technicals. I don't even know what it is about. But we're seeing MSO stocks widely believed to be trading below intrinsic value, and yet it's not reflected in that price of MSOs nor the MSOS ETF you mentioned earlier. But it can be attributed to that negative free cash flow and burning cash rates at alarming rates. A lot of CFOs are kind of embracing the importance of net income, free cash flow, as you've mentioned, as a critically important performance metric. But how's your performance, your financial performance been, and why are these MSOs finding it incredibly difficult to produce a profit?
I think for a couple of different reasons. This is it's an overtaxed industry. I think that, so the tax burden, with 280E paying full tax rate on your gross profit is absurd. And that's before you start talking about, local taxes like community host agreements and other BS like that. So I think that that's one of the things. I think that largely MSOs have been, operating in protected markets. Most of them have sort of steered away from, a market like, Washington or California. And they've been in limited license states. And as the prices have dropped there, I think that's sort of the equivalent of Warren Buffett's tide going out, and you're seeing who's going to be swimming naked or not. Mm-hmm. So that's a component. And then I think the third component, which I touched on earlier, is there is a dearth of talent. And so the MSOs went in and they said, okay, man, we're well capitalized. These states are opening up for medical or recreational cannabis. Let's go get licenses. Let's build out our operations. So assuming you had capital to do that, you don't have the human capital to do that. Like, it is a real issue. And so, I was out to dinner with, a couple guys who are engineers from a competitor last night. And in the early days of cannabis, it was just, okay, well, that state's opening up. Yep. That's an attractive state. Let's go do it. And, we all built these facilities and we got into, building out retail and so on and so forth. When you talk to guys like I was talking to last night, who have been in, the cereal business, and they've been in low margin, high throughput industries, they come in and they marvel at how much work the cannabis industry has to do to really streamline their cost structure and make sure that they're efficient operators. Like, no knock on Curaleaf at all, but Curaleaf's a well-capitalized roll-up. Like, they've sort of bought these disparate operations in all these different states. And back when I was running money as a small cap manager, like the adage used to be, you roll up, you blow up, you grow up. And so currently, we're all in that phase of, okay, you bought all these assets. Now it's time to, make sure that you rationalize and optimize them. And then, you go into the phase of, all right, we're going to pursue profitable, reasonable growth now. And so I think that we're kind of in that middle phase right now. And there's not very much talent coming into the industry from outside of the industry who has the kind of know-how. And we feel like we're really well positioned because we feel like we do. We've been able to attract, some pretty talented folks from, other companies. And then, just given our experience in some of these highly competitive states, we've been fighting this battle for a bunch of years, making cash flow. So, we feel that puts us in pretty good position.
You mentioned just before about looking for opportunities to raise your ROI while reducing risk, and just mentioning human capital and the abundance, the necessary need for it, and then the lack of availability of it. And And yet I'm wondering if maybe you've already tackled some of those issues with automation and innovation. So one of Forefront's facilities incorporates fully automated machinery, producing 100,000 edibles, 12,000 pre-rolls, 9,000 vape carts per shift. So is automating a difficult decision to make? And can you discuss any exciting projects or innovations that Forefront Ventures is currently working on to, again, do the same thing, raise your ROI and reduce your risk?
Yeah, I mean, automation is going to have to be absolutely critical. And, I think that if you are going to be a survivor, you need to figure out how to automate and take the labor out of every part of the value chain that you can. Because, I think that we're probably the only industry in the world that isn't seeing inflation with our core product. We're actually seeing deflation. So I think that is really the key. And I think that if you can give a low cost, high quality product, the elasticity in cannabis is pretty remarkable. So I lost the last part of your question, Josh. I'm sorry.
No, it's all right. So you talked about automating, if that was a difficult decision to make. You said no. And then discussing exciting projects, other ways of reducing risk and raising ROI.
Yeah. So, it was not a tough decision at all. Basically, when you look what we did in California, we basically took the automation that we've learned in Washington State and we put it on steroids to take it down and put it into California. So, what do you need to do? You need to take the labor out of, trimming and packaging. You take the labor out of rolling pre-rolls and put them in the package and putting labels on. You need to take the label out of filling vape carts. You need to take the labor out of making, any type of edible. And so, one of the things that the cannabis industry is struggling with a little bit is, not being able to take stuff over state lines. So, instead of addressing a market of 360 million people, the biggest market you can address is really California, which is 40 million people or something like that. So, for instance, our edible machine in California, you were throwing out some of the metrics. I think we can make something of, north of 20,000 boxes of edibles in one 8-hour shift. This is the same machinery that they use to make Starburst. So, when they make Starburst, it's a red Starburst, it's an orange Starburst, it's a yellow Starburst. They turn on those machines, and those machines don't turn off for years at a time. Mm-hmm. And so, what I'm saying, it's absolutely critical that you have automation and you're wringing out labor, really maximizing the scale and leveraging that automation. Is probably really going to show itself in, when we get to interstate commerce, which is probably a few years down the road at the very earliest. But, you absolutely need to be, thinking about what can we automate and what can we, where can you get the labor out? So we've been playing with pre-roll machines in Washington for 6 years. And so we've been playing with, edibles manufacturing and automating that for 6 years in Washington, almost 7 years. And so, there isn't one magic bullet of, okay, you automate this and then you're competitive. This industry is all about experience, having folks that have skinned their knees along the way and continuing to innovate and make sure that you're innovating while keeping your costs low. And I think that automation has a big piece to do with that.
Mm-hmm. Oh, well, where do you see the cannabis industry evolving in the next 3 to 5 years as it pertains to finance, and how is Forefront preparing for that?
I think that, and what I'll say internally is in the next 4 or 5 years, this is going to be, I believe that we're going to be traded on, the NASDAQ or the New York Stock Exchange. And, the way that I describe it, to my partners at Forefront is, guys, this big wave's coming. It hasn't come yet. But when it does, there are going to be a handful of us, call it 10, who are going to have big surfboards. And so I think that, we've kind of been, languishing on, some lesser exchanges. We haven't had the access to capital. We haven't had, general folks who, my dad tried to buy Forefront stock through his Morgan Stanley broker the other day, and he couldn't do it. So the custodian and sort of the plumbing of having investors come into this space is just not there yet. And I think that we are on the cusp. I think, when I'm in Boston, and I started my career as MFS here in Boston, and then I was 11 years at BlackRock here in Boston. And so I have a lot of buddies still in the financial community up here in the Northeast, and a lot of whom are personal investors in Forefront. And one of the things that I've found interesting is, we have portfolio managers who own Forefront individually that they haven't been able to buy in their multi-billion-dollar funds. And I think that safe banking, if you got some piece of acknowledgement from the federal government that this was okay to do, dealing in cannabis, you weren't committing wire fraud, I think the compliance departments at big mutual fund shops will start to jump in. I don't think that that's going to take specific uplisting language or anything like that. I think that this has been an incrementalist issue. We've gotten medical. People realize, okay, cool, we can have medical. The sky's not going to fall. Now we can do recreational. Oh, wow, the crime didn't go through the roof. This was not a bad thing. This is an incrementalist issue, cannabis. And I think it's an incrementalist issue on the capital markets side too. Except for, I think that once you get banking, I think that this is going to be, I think some things are going to happen in very rapid succession after that. From being able to, have real custodians, having, the Fidelities and BlackRock be able to come in and buy these things in earnest and have real price discovery and of these names, and being listed on real exchanges, where, we're treated like we're treated like the companies that I think we deserve to be treated with, given, our growth and revenue profile. And I think that, those of us that are going to be long-term success stories here are going to be able to show a lot of profitability as well.
And there's no pushback. And I think that's the biggest thing. If there's no pushback, it'll happen eventually. So the biggest thing is there's money involved, and they're going to want a lot of that money in their own pockets eventually. And as long as there's no pushback and they're not going to lose their seats or their election, it'll happen eventually. So that's the good news. But I think with that, we're gonna have to roll this one up. So I want to thank my guest, Andrew Thut. He's the CFO, Forefront Ventures, available in the U.S. under ticker symbol on the OTC markets, FFNTF. Andrew, where else can they find you at?
We are at forefrontventures.com, number 4frontventures.com, and we're also on Twitter and LinkedIn and all that good stuff. So
all over the place.
Appreciate you having me, Josh, and thanks everyone for listening.
Yeah, I'll put Andrew's contact and LinkedIn in the show notes. But with that, I think we're out of here. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.